Welcome to this Iron Financial Explainer. Look, if you're tuning in right now, you aren't here for surface-level fluff or generic market cheerleading. You're here because you want to forge a stronger portfolio. You want to cut straight through the market weakness, and you want to understand the real, absolute structural integrity of the companies you are pouring your hard-earned capital into. I'm your lead analyst, and today we are taking Visa's Q3 2026 financial results, and we are putting them under immense, crushing pressure. We need to see if the concrete of this business actually holds up, or if the whole structure cracks under the weight. So hit that subscribe button right now, because we are about to stress test these numbers like absolutely nobody else in the market.
Yeah, and I'm the market skeptic. I'm sitting right here to represent you, the everyday investor. To be honest, I really do not care about the slick corporate PR spin. When I see these massive, unbelievable numbers flashing across the ticker, my very first instinct is to just stop and ask, okay, is this hype or is it real? Are we looking at a highly durable financial fortress here, or is this just another market trap that's waiting to collapse on retail investors the second the macro environment shifts? We've got a lot of ground to cover. Let's get to work.
Okay, let's dive straight into this by looking at the headline beat, because the prevailing narrative in the broader market right now is, frankly, all about macroeconomic anxiety. It's all inflation, interest rates, and this constantly looming fear of a consumer recession. But Benzinga is reporting a highly reassuring read on the U.S. consumer specifically, coming out of Visa's latest earnings. And the bedrock of that reassurance, the foundation of it all, Visa just processed over $4 trillion in payments volume for the very first time in its history. I want you to really think about that for a second. $4 trillion flowing through their network pipes in a single 3-month quarter. It's honestly an absolute masterclass in scale, and it heavily sets the stage for what looks to be a highly resilient consumer foundation.
Hold on a second. Time out. $4 trillion is a massive, heavy number. Sure, I'm not denying the scale. But as the market skeptic, I have to step in right here and challenge the hype right out of the gate. Is this real, actual structural strength, or is it just an inflationary mirage? I mean, are we seeing actual, durable transaction volume growth, or are consumers just out there swiping their cards to pay significantly higher prices for the exact same goods? We desperately need to know if this growth is a legitimate, long-term opportunity for our capital, or if it's just a market trap built on the back of a highly leveraged, totally exhausted consumer. Because you and I both know you cannot build a skyscraper on a foundation of sand. It will eventually fall.
Section 1. The solid foundation.
That is exactly the right question to ask. So let's pour the concrete and really examine Visa's top-line performance metrics. We need to see exactly what this foundation is actually made of. We're going to strip away all the media noise and look directly at the raw financial architecture they've reported for Q3. On a GAAP nominal dollar basis, Visa delivered an incredibly powerful 14% growth in net revenue year over year. That is intense, serious growth for a company that is already operating at this kind of hyperscale. But right next to it, GAAP earnings per share, or EPS, only grew by 10%, coming in at $2.97. Wait, hold up. That's exactly the kind of glaring discrepancy I look for when I'm tearing through these earnings reports. If your top-line revenue is growing at a massive 14%, but your bottom-line earnings are lagging behind at just 10%, that means margin compression. Point blank, it means it's costing them more money to actually generate that revenue. Look, let's drill down a bit further into the filings before we officially call it a defect in the concrete. Because if you adjust for non-GAAP metrics, meaning stripping out things like foreign currency impacts and specific acquisition costs, their non-GAAP EPS actually grew by a very healthy 11%, bringing it to $3.32 per share. And on top of that, they faced a notably higher effective income tax rate this quarter. It hit 17.6%. So while that 10% GAAP EPS growth might look like a slight structural lag on the surface, the core financial architecture of this company is still expanding highly effectively when you look at it on an adjusted constant dollar basis. And to truly appreciate the sheer scale and weight of this foundation, we really have to look at the absolute dollar figures here. Q3 net revenue didn't just grow a nice percentage, it came in at an absolutely intense $11.6 billion.
Okay, but for context, what was Wall Street actually expecting them to hit?
The street's consensus was $11.396 billion. So Visa didn't just meet the expectations, they aggressively cleared them by over $200 million. Listen, when your base is already this wide, generating an extra couple $100 million in a single quarter completely proves that the payment pipes are not only fully intact, they are actively pushing maximum capacity.
Section 2. Cracks in the armor.
All right, the top line is heavy. I'll absolutely give you that. But no structure is perfect, and I'm actively looking for underlying structural weakness. And here is a glaring one. We just spent all this time celebrating 14% revenue growth, but their GAAP operating expenses just jumped by an incredible 19% year over year.
You do not have to be a seasoned Wall Street trader to know that when your expenses are growing 500 basis points faster than your revenue, capital is bleeding out of the system. It's unsustainable. What is actually going on here? Is management just completely losing control of the budget?
It's a fair challenge for sure, but again, if we put on our hard hats and dig deeper into the actual filings, we see that non-GAAP operating expense growth was actually 17%. Now, still higher than revenue, yes, I grant you that. But part of this massive gap discrepancy involves a very specific $250 million deposit that Visa made into a litigation escrow account on June 25th. They are heavily provisioning for the U.S. retrospective responsibility plan, and the entire point of that is to permanently insulate Class A common stockholders from financial liability down the road. So, yes, expenses are absolutely running hot right now, but they are laying heavy defensive rebar to protect the structure against future legal headwinds. It's a highly aggressive capital expenditure, but you can heavily argue it's a completely necessary one for long-term structural durability.
Okay, fine. The legal maneuvering explains some of the cash bleed, but what about actual, on-the-ground consumer behavior? The 2026 U.S. payments volume growth. From April through June, there is a very solid upward trajectory. Credit volume peaked up near 13% in June, and debit volume was steadily pushing 10%. But right at the tail end of the data, July 1st through the 21st, the growth lines completely converge and just drop straight off a cliff. They plummet all the way down to around 8.5% total growth. If the U.S. consumer is supposed to be the absolute bedrock of Visa's revenue, this visual downward trend heavily suggests that the consumer is actually running out of gas. Honestly, this structure looks like it's severely weakening right as we are trying to enter the fourth quarter.
I agree. It looks like a very sharp drop on the surface, but we have to look past the immediate visual panic and understand the actual mechanics at play here. According to Cantor Fitzgerald analyst Ramsey El-Assal, who we noted earlier on the Benzinga report, this July dip is merely transitory noise. It is absolutely not a long-term deterioration in the underlying consumer spending trends.
Market skeptic? Okay, explain that to me. What specifically makes a massive volume drop like that just transitory?
It really boils down to three structural things. First, the timing of Amazon Prime Day actually shifted this year, which drastically alters the year-over-year July comparisons. Second, there was a significantly less favorable calendar mix compared to June, meaning, quite literally, the number of weekend processing days was different, which warps the data. And third, lower fuel prices at the pump. When gas costs less, payment volume drops simply because the transaction sizes are smaller, not because consumers are suddenly staying home and locking up their wallets. The underlying demand remains structurally, fundamentally sound. The surface-level metrics just took a very temporary, explainable hit.
Section 3. The heavy lifting. Now that we've really stress-tested those cracks, let's move right into the core engines of Visa's growth. We need to see what's actually carrying the heavy weight of this massive quarter. Total cross-border volume grew by a massive 13% on a constant dollar basis, and actually 12% if you exclude intra-Europe transactions. This is incredibly important because this is the absolute highest margin business Visa does. When money crosses international borders, Visa collects premium tolls on those bridges. Meanwhile, total payments processed grew by 10%. We are talking about 71.7 billion individual transactions processed in just 3 months. To break that down, that includes roughly 32 billion credit transactions and over 58 billion debit transactions. This alone proves the raw structural integrity of the business model. The base volume is scaling, and the highly profitable, high-margin international volume is scaling even faster.
Looking closely at the revenue lines, service revenue hit a very solid $4.9 billion, representing 14% growth. But the real heavy lifter here, the crane doing all the work, is data processing. It pulled in a staggering $6.0 billion, up an incredibly strong 17%. That 17% growth in data processing provides a massive, undeniable lift for the entire balance sheet.
Market skeptic. Okay, but you cannot ignore the client incentives. Client incentives are sitting at $4.7 billion, and they are growing at 18%. Let's be real here. Client incentives are essentially kickbacks. They are discounts Visa pays out to banks and merchants just to convince them to route their volume through the Visa network instead of a competitor. If those incentives are growing at 18%, which is faster than both service and data processing revenue, aren't they basically just buying their own growth?
Look, it's just the fundamental cost of doing business at this level of hyperscale. Yes, incentives grew 18%, which undeniably acts as a headwind to net revenue. But you have to think like a builder. By aggressively locking in these massive client renewals right now, Visa is permanently securing long-term structural volume for the next decade. They are absolutely willing to pay a premium today to ensure that the concrete sets permanently for tomorrow.
And frankly, if you want absolute undeniable proof of durability, just look at this number. $6.2 billion. That is the massive amount of capital they returned directly to shareholders in this quarter alone. They executed $4.87 billion in share repurchases, and they paid out another $1.27 billion in dividends.
Right, and you can only realistically return that kind of insane capital if you actually have the underlying free cash flow to support it. Otherwise, you're just taking on debt to pay dividends, which is a massive red flag.
Exactly. But they aren't doing that. Their net cash provided by operating activities was an astonishing $6.55 billion. You subtract the $417 million in capital expenditures, and you are left with $6.13 billion in pure, unadulterated free cash flow. They generated over $6 billion in raw cash, and they turned around and handed essentially all of it right back to their investors. That right there is the absolute hallmark of an ironclad financial machine.
Section 4. The Blueprint.
So the past is incredibly solid, but as we always say, investors do not buy the past, they buy the future. We'll quickly fire off the Q4 constant dollar guidance here so you can clearly see the structural blueprints management has laid out for the rest of the year. Management is officially projecting low double-digit to low teens net revenue growth for Q4. Furthermore, they expect diluted Class A common stock earnings per share to grow in the low end of the mid-teens. Notice how they are deliberately maintaining a very tight tolerance on those projections. And importantly, operating expense growth is also forecasted at the low double-digit range. This implies very heavily that they fully expect to get those elevated Q3 expense margins back under control, actively aligning their expense growth back down with their revenue growth. If they can actually execute that plan, the blueprint moving forward is extremely bullish.
Section 5. The final verdict.
We've stressed the foundation, we've found the cracks, we've weighed the heavy lifting, and we've reviewed the blueprint. As the lead analyst, my verdict is completely clear on this one. The solid foundation significantly, overwhelmingly overpowers the transitory cracks. Yes, operating expenses jumped 19% on a GAAP basis. And yes, we saw a slight, scary deceleration in early July payments volume. But the sheer, unimaginable scale of the $4 trillion volume, the massive 13% growth in highly profitable cross-border transactions, and the absolute fortress-like generation of $6.1 billion in free cash flow make this an unparalleled compounder in the market. You know, I actually have to agree with you here. I came into this analysis fully expecting to find a trap, but the numbers honestly do not lie. The July dip is very easily explained by the Prime Day shift and the drop in gas prices. The expense jump is heavily tied to responsible, long-term litigation provisioning. When you are successfully processing 71.7 billion transactions a quarter and immediately returning $6.2 billion to your shareholders, you aren't a market trap. You are a highly durable opportunity. The metal has been rigorously tested and it absolutely holds.
To reinforce this construction metaphor just one last time before we wrap, let's look closely at the exact words of CEO Ryan McGurney from the earnings call. He confidently stated, "As the leading hyperscaler of payments globally, we are designing, building, and shipping products at an increased velocity, positioning Visa, our clients, and the ecosystem to capture the opportunities ahead and drive growth." They are clearly not just resting on their legacy network. They are actively building out new value-added services and commercial solutions at a vastly increased velocity.
So, the absolutely crucial takeaway is this. The structural integrity of Visa is fully intact. We've done all the heavy lifting of breaking down these Q3 2026 earnings, cutting through the broader market weakness, and showing you the raw, unfiltered data.
But now it's on you. The data is clear, but your portfolio strategy is deeply personal.
Exactly right. With the blueprint clearly laid out and the foundation verified by the numbers, how are you positioning your portfolio based on these results? Are you buying into this underlying strength? Or are you still too worried about the broader macro environment pulling the rug out? Leave your thoughts and your own analysis in the comments below. Keep forging a stronger portfolio, and we will see you in the next Explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.